Hi everyone. So some of you might have already seen it, but just last week I crossed a lakh subscribers and call it my astute sense of timing, I got to this target on the 365th day of launching the YouTube channel. I'll be talking about my experience in a separate video, but now that this milestone has been reached, I thought this might be a good opportunity to try out some different formats. So this one here is what I call the third eye. I mean, everyone has an opinion, right? So what you have is your first opinion. Then we ask someone else for their opinion and that becomes a second opinion. And then there is me, Shankar, with his third eye, always ready to give you a third opinion. And in these series of videos, every week, I'll be discussing 3 or 4 major investing related stuff that's happening around us, which I think is relevant. And as always, I'll try to focus on what we can learn from this. And not just learning, I want to see if there are some actions we can take around what we have learned. So this will be a little different to my regular videos. It will be more recent, more news-based, but it will be a work in progress and I'll definitely want to make improvements as we go along. Let's begin. The big mover of this week was of course Zomato Limited. The share price gained by almost 10% on the announcement of its Q2 results, whose biggest highlight was a second quarter of profitability on a consolidated basis as the company reported a net profit of 36 crores as against a net loss of 251 crores as of last year. Now, if you recall the video I did on turnaround stocks, 2 quarters of profits after a series of losses is a big trigger point and warrants more examination. So let's get into it. So on the revenue front, Zomato delivered 2,848 crores, registering a growth of 72% as compared to last year, and on a sequential basis, it grew by 18% over the last quarter. Now, as a practice, the CEO of the company, Dipinder Goyal, releases a combined shareholder letter and results, which looks more like a marketing document, and it's very clever because it allows the company to dictate the narrative, and this document is going to be our first point of inquiry. Okay, the letter says that firstly, there was healthy growth across all Zomato businesses, which is food delivery, quick commerce, that is Blinkit, and thirdly, going out, which includes dining and events like Zomaland, which is their food carnival. So in terms of the gross order value or GOV, Zomato grew this number by 47% on a yearly basis and by 13% as compared to last quarter. Now, the point to note is that this GOV growth did not come from order value, which was mostly flat, but it was almost entirely led by growth in order volumes, which I thought was interesting because volumes in the food delivery business is also a function of other things. For example, during monsoons, the growth is impacted because of a lower availability of delivery partners. If there is something like the World Cup, which is happening now, that the demand for deliveries definitely goes up. But then during the Shraddh period, many Indians observe a fast, again, which means the demand has gone down. So much like any business, there are ups and downs in the food delivery business as well. And FYI, in Zomato's own commentary, they are cautiously positive for this ongoing quarter. Anyways, the wider picture and something that was mentioned in the Q1 letter as well is that Zomato is targeting a revenue compounding of 40% over the next 2 years, which basically means Zomato is aiming to double the sales from 7,000 odd crores to almost 14,000 crores by FY25. And as the Q2 letter says, we remain on track to deliver that outlook. Okay, now let's look at the big show, the profitability. And after many loss-making quarters, Zomato delivered not 1 but 2 quarters of net profits, with the latest quarter yielding 36 crores. Now, what's interesting is that although this is a net profit, the company actually had an operating loss, and it was the other income part of the P&L statement that made up for it, which amongst other things includes treasury income and a rise in interest rate, which did them a world of good. In numbers, other income contributed 681 crores in the last financial year and has already given over 400 crores in the first 2 quarters of this year, which is quite a sizable chunk. In fact, when you get down to reading the company's quarterly results, you'll notice the generous use of the word adjusted EBITDA, which is Zomato's version of what its EBITDA is and what they believe is an accurate picture of their financial performance. Now, before you start posting memes, here's how Zomato defines its adjusted EBITDA. And while we won't go into the details, I should definitely mention that almost every new age company, so Zomato, Paytm, PB Fintech, that's Policybazaar, Oyo, PhonePe, everyone uses adjusted EBITDA, and therefore it's a number that every investor should have an understanding of when evaluating any new age internet enabled business. Okay, so other than the revenue and the profits, the shareholder letter also has a longish reference to Zomato's Gold program. And to cut a long story short, the adoption of Zomato Gold is rising with 38 lakh members who together contribute 40% of the GOV in the food delivery business. A gold order is less profitable than a non-gold order because of the benefits that the program offers, which brings down the contribution margin. But then, if the management can build price and cost efficiencies together with the fact that Zomato Gold customers order more frequently than a non gold customer, then this program can lead to big benefits in the future. Come to think of it, a subscription model is something investors should look forward to, and this need not always be an internet enabled business like Zomato or a Netflix. And even the insurance model with renewals come within the same framework and has to be looked differently from how traditional businesses are evaluated. Particular to Zomato, I think the fact that this industry is a duopoly actually works to its advantage. And I think over time, there is not going to be any real price competition between Zomato and Swiggy. This is conjecture on my part, but that's what I think is going to happen. And by that logic, the same goes for Indigo and Air India, Bharti Airtel and Jio, Flipkart, Amazon, Ola, Uber, etc. This may not be the best thing for consumers, but with regards to Zomato and Swiggy, it's difficult to see big competition coming in from the likes of DotPay, Thrive, Amazon, or the ONDC due to its limited networks. Add to it the fact that there is network advantage, branding, last mile delivery, data, changing consumer behavior, and wide geographical reach. At least for me, it's very difficult to see why these two companies will not dominate this industry in the coming future. I think the only major risk here is regulation. And because food delivery is heavily regulated in many countries, one has to be watchful of that in case some news to that effect comes along. Anyways, as it stands, Zomato has crossed the 1 lakh crore market capitalization mark for the first time since January of 2022. And with the stock hovering around 120 rupees, its 52-week low of some 45 rupees is long forgotten. The next big event I want to cover in this edition is Honasa Consumer Limited, or Mamaearth as it's popularly called, which got listed this week. Now, we've seen a lot of new age companies getting IPO'd in the last 3 years, so there's already a template, and as expected, Mamaearth followed that same course of action. Let's start with the offer itself, and the company raised a total of 1,700 crores, of which 78% is offer for sale. That is, this money will go towards paying the early investors. So people like Kunal Bell, Rishabh Mariwala, Shilpa Shetty. Actually, I feel a little sorry for Shilpa Shetty. She made only 7 times her investment, while the others made a lot more. And of course, the two promoters, Varun and Ghazal Alak. So with the bulk of the IPO proceeds going towards giving an exit to the existing shareholders, it means only 365 out of 1,700 crores. So just 21% of the money raised is going towards growth activities. This is an important point when evaluating an IPO, and I also have some data on this. So in 2021, 60% of the funds raised through IPOs was actually OFS, offer for sale. And in the same year, there were 14 IPOs that were fully proposed for OFS, which means not a single rupee from that IPO went into growth activities. Now, when I examine the performance of these companies like Easy Trip Planners, Clean Science, Nazara Technologies, Sapphire Foods, etc., while a few of them managed to double investor money, many of them are either negative or are yet to beat standard inflation. Another story surrounding the Mamaearth IPO is an investment of 253 crores by 7 mutual funds across 19 schemes. Understandably, these 7 guys are facing a lot of criticism, especially on social media, with retail investors having concerns over the company's rich valuations. And personally, I think fund managers are accountable and should actively respond to these customer queries and explain their valuation logic, which in this case is a lot different from what they generally talk about in terms of positive cash flow, good profit margins, high return on capital employed, etc. In fact, speaking of valuation, Mamaearth did this IPO valuing itself at 10,425 crores at the upper limit of 324 rupees a share. And there's this one report by MK Global Financial Services that says the stock could be deemed attractive at this price if the company doubles its revenue in 3 years and improves its EBITDA margin to 26%. To put that into perspective, for the financial year 2023, Honasa Consumer Limited reported a revenue of 1,492 crores with an EBITDA margin of 1.5%, which means there's a lot of work this company needs to do from here. Of course, not everyone agrees with MK's assessment, and in case you're interested in evaluating the stock, here are some business risks that definitely need to be factored. So firstly, Honasa does not manufacture the products and relies entirely on third-party manufacturers, with the top three contributing around 50% of the total purchase value. Secondly, the company derives a significant amount of revenue from a limited number of products. In fact, the top 10 products contribute around 28% of the revenue, and a bulk of the sales is related to a single brand, which is Mamaearth. The next risk is the distribution, and the company depends heavily on influencers, which is probably why it acquired a majority stake in Momspresso for 152 crores, only to write off that investment in a few months. My point is, influencer marketing has its risk and one needs to tread carefully. Next up are the growth challenges itself, and while Mamaearth starts from a low to medium base, the BPC, that is the beauty and personal care market in India, is growing at 11% as a whole. In that context, it's pleasant to note that the industry is growing at 29% in the online space. But that being said, the company needs to get its growth strategies absolutely right, as this market is intensely competitive. Net at 10,400 odd crores, the IPO has valued the company at 104 times its estimated annualized earnings and at 5.6 times its estimated revenues for FY24. So yes, even I feel these are rich valuations when compared to the larger FMCG peers, and especially for a young startup that has only recently turned profitable. It'll be interesting to see how Honasa shapes up in the years and months to come, and especially when many of the new age companies are struggling or have subsided their growth ambitions. Okay, Zomato and Mamaearth were two of a kind companies, so no more startups, and the next financial happening I picked up for this edition is the launch of a momentum fund by Quant AMC. Now, I haven't done a separate video on momentum, but I've made adequate references to it in a couple of important videos, and to put it in a sentence, momentum investing is a strategy where you buy stocks that have been performing well recently, believing that their good performance will continue. Yes, it sounds counterintuitive, but that's how it is, and the more I've read about it, the more it has appealed to me, and the proportion of momentum funds in my own portfolio has been steadily rising over the months. Now, whenever I've spoken about it, it has always been about a momentum index fund, and while actively managed momentum funds were restricted to PMS structures and small case, we now have not one but two actively managed momentum fund offerings from Samco Asset Management and Quant AMC respectively. From what I've understood, while the index schemes, which is either the Nifty 200 Momentum 30 Index or the Nifty Midcap 150 Momentum 50 Index, so while these schemes follow a clearly defined methodology, the actively managed funds have their own proprietary system, which is not that easy to decode. But here's what I could figure out, and unlike an index offering, Samco takes exposure only when there is momentum in the market. The team rebalances as the situation demands rather than following a rigid schedule. There is no capping on the number of stocks, the universe is wider, and the fund even invests in microcap companies that show momentum attributes, and stock selection is done on the basis of absolute and relative momentum, while the index product only uses relative momentum. Likewise, Quant's momentum offering works on the fund house's proprietary thematic momentum strategy. Actually, let me read out this paragraph from their scheme information document. Our investment approach revolves around a thematic quantitative momentum strategy, and therefore our investment thesis aims to forecast the expected return using momentum attributes and autocorrelations to optimize the risk-return trade-off of our portfolio, primarily derived from multi-dimensional research. Wow, it's quite a mouthful, isn't it? But what I think it means is that the Quant AMC team identifies stocks that have momentum, they then set it up against the VLRT framework, which I discussed in another video, and after applying some constraints and risk attributes, this method gives them the ideal portfolio. So the big question is, does applying to the Quant momentum fund, or for that matter the Samco fund, does it make sense or not? Now, obviously, I don't have a direct answer for this, but momentum has been working, and this table here is enough proof of that, with the momentum index handsomely beating the Nifty 50 most years. If you're keen on investing, perhaps one can split the money between active and passive strategies. But if you're asking if I would be keeping this money in a momentum investing strategy over the long run or not, then my answer is a resounding yes. Okay, so we've gone through 3 financial happenings. There are some nuggets of information here, and in this last section, I would like to go through some questions I received in the past week and my answers to the same. Right, the first one is on how one can fetch the closing values for the momentum index. Alright, so simple enough, the data one requires is very much there in this website niftyindices.com. And it's not just the momentum indices, but you can get this data for the Nifty 50, Midcap 150, Nifty Banking Index, debt, and dozens of different indices. So here are the steps. Firstly, go to niftyindices.com. On the top navbar, you will see reports. Within that submenu, click on historical data and a new page will be rendered. In the top drop-down field, which is written in orange color text, please select Total Returns Index Value, then select Equity from the next drop-down, then the index of your choice, which in this case is either the Nifty 200 Momentum 30 or the Nifty Midcap 150 Momentum 50. Then select the dates. Remember, this allows for only 365 days at a time. So you might have to make one file for every year, which is what I do, and then click Submit. So this will give you the required data, and as a practice, I download this data on a CSV file and I then access it on Microsoft Excel. And that's it. That's the process. The second question I have for you is, and the person here is asking, it's not clear how the TRI is getting calculated. Okay, before I explain this, it's important to understand the difference between TRI and PRI because I get lots of comments saying that the data I show and the data the viewer finds in various websites is different. So PRI stands for Price Return Index while TRI stands for Total Return Index. For instance, the Nifty value you see on a daily basis, it's PRI because it's compiled purely from the price of different stocks. On the other hand, TRI includes not just the returns we make from the price appreciation or if the price falls, but this also includes the dividends received as well. For example, the Nifty 50 PRI as on the 6th of November 2023 is 19,411 points, while the Nifty 50 TRI for the same date is 28,519. So what's happened is that over the years, the dividends have accumulated inside the TRI calculations, and that's how this big difference between PRI and TRI has come about. Now, the calculation of the TRI is a simple formula as one can see here. It includes the PRI and the index dividends wherein it's assumed that when a stock declares a dividend, then this dividend is reinvested back into buying more units of the index. It's not a formula you and I need to remember and calculate. You can use the method I explained in the previous question on momentum, but understanding the concept is very important when measuring performance. And the third and final question of the week is based on the forensic accounting video, and it's a long one, so I'll explain it here. Now, Mr. Surjit has put forth two depreciation scenarios, one using the straight line method and the other using the written down value approach. His question is from the Dr. Agarwal Eye Hospital example I took in the video, and he's actually right when he puts forth the query that the depreciation under the written down value method should always be lower than the straight line method. But in the case of Dr. Agarwal, it seems to be the opposite. Now, obviously, I don't have specifics on the company, but if I extend Mr. Surjit's example by one more year, see what happens. So because depreciation has been completely provided for under the straight line method, no further amount needs to be apportioned here. While in the case of the written down value, I still need to provide 6.55 under the depreciation column. Again, I don't know specifically what has happened in the case of Dr. Agarwal's Eye Hospital, but this can be one scenario which explains why a change in depreciation policy was responsible for a jump in the net profits. So that's what I had for this week. This video seems to have gone a bit longer than what I'd expected, but between this collection of perspectives, opinions, and information, I sincerely hope you found value in this new format, and I would love to know from you how this can be improved. Once again, thank you for your time. Do tap the like button. Do share this video in your WhatsApp groups. Wishing you a very happy Deepavali. Wishing India the very best in the semi-finals, and I'll see you again next week. Until then.